And it often drives me crazy, how short people's memory is. Thinking that everything is okay just because this last event is behind us in the rearview mirror. There are so many things bubbling under the system that people don't quite understand. And this is one of the things that I think is going to only make this situation much worse than it is, because you can't get out of the way of what you don't. People are talking about now, all of a sudden, they're concerned about the debt ceiling and focusing on a $31 trillion debt, ignoring the fact that the unfunded liabilities in this country are over 4 times the debt. Medicare, Medicaid, Social Security, which in and of itself is $76 trillion underfunded, 2.5 times.
It's been almost a month since the collapse and closure of San Francisco-based First Republic Bank. The subsequent purchase of the bank by J.P. Morgan Chase seems to have placed a lid on the U.S. regional banking crisis, at least for the moment. 2 months ago, 3 small to mid-sized U.S. banks failed, triggering a sharp decline in global bank stock prices and widespread among depositors and investors all through the United States. The collapse of Silvergate Bank and Signature Bank can be attributed to their significant exposure to the cryptocurrency industry, which experienced a lot of turbulence late last year. Silicon Valley Bank's collapse came as a bigger shock, and it was, at the time, the second largest bank failure in U.S. history. The Santa Clara-based bank failed when it triggered a bank run by selling its treasury bond portfolio at a large loss, raising widespread panic and concerns about its liquidity. With the rising interest rates, the bonds had lost significant value and should have been held until maturity. To stop more bank runs and what would have turned into another global financial crisis, some of the world's major central banks, including the Federal Reserve, the Bank of Canada, Bank of England, Bank of Japan, and the Swiss National Bank, swapped in to provide significant liquidity. The top 10 banks in the U.S. were also helping to shore up the balance sheets of the lenders that took the worst hits. But even a $30 billion credit infusion from 6 major banks could not save First Republic Bank, which had over $100 billion in uninsured deposits quickly withdrawn. Its stock price continued to plummet, and the FDIC finally sold it off to J.P. Morgan on May 1st. Of course, the shady sweetheart deal will cost the FDIC about $13 billion, according to a statement from the regulator. Despite the severity of the events of the past 2 months, depositors and investors are exhibiting dangerous signs of normalcy bias, the tendency to underestimate a potential hazard, with the belief that things will continue as they have in the past. This is how Miles Franklin President Andy Schectman views the current investment scene and the attitude of investors in the United States. According to Schectman, this period is just calm before the storm. Unfortunately, many investors are oblivious to the coming storm. As such, they are much unprepared. During a recent discussion with Liberty and Finance, Schectman discusses his outlook on the U.S. economy as the county battles a debt crisis and a possible disastrous default if the debt ceiling is not raised in a matter of days. Please watch, share, and like this video. Also, ensure you subscribe to the channel, check out our other videos, and drop your comments and observations in the comments section below. Thanks, and enjoy the video.
Because you can't get out of the way of what you don't see coming. And so many people have... they're looking at what we saw over the last month or so with the banks as something in the rearview mirror. But I mean, when you look at the bigger picture, take a look at the macro side of things. On one hand, you know, the banks, it's okay. You know, it was smoothed over by J.P. Morgan. People are talking about now, all of a sudden, they're concerned about the debt ceiling and only focusing on the fact that we continue to bump up against the stupid debt ceiling and focusing on a $31 trillion debt, ignoring the fact that the unfunded liabilities in this country are over 4 times the debt. Medicare, Medicaid, Social Security, which in and of itself is $76 trillion underfunded, 2.5 times the size of the national debt. Government military pensions. You know, the debt burden is enormous and not going away. When you talk about how do we pay that off, how do you pay off $150 trillion in unfunded liabilities on top of this debt? There's only 2 ways. And Richard Russell, my mentor, was well ahead of his time 20 years ago when he said the Fed has 2 choices, but to inflate or die. Take a step back even further and look at the head of the International Monetary Fund, Kristalina Georgieva, who said the problem with the banking sector in the United States is complacency. that the ability of people to, with a click of a mouse, move their money is the problem. And that requires much, much more supervision and regulatory action. You have the two of the main advisors to the president right now, as I mentioned last time on your show, Jared Bernstein, whose whole thesis, who is now the head economic advisor to the White House, is the removal of the dollar as the world reserve currency. You have Lael Brainerd, who's another advisor to the White House, whose whole thesis is removal of the banks. You take a look at what's happening right here, and you could draw a screenplay pretty easily to where what's happening here domestically would fit into both of their screenplays, where one gets his wish as the dollar losing its reserve, and the other gets her wish as all of the banks are gone, and we go full modern monetary theory directly to the Federal Reserve, an entity that is aiding and abetting this exodus from the banks with rates higher than you can get at any bank without the systemic risk of being pulled down by the banks. And that's why we're seeing a massive departure, not just from the regional banks, but from the commercial banks too. And then you talk about all the things that we've talked about ad nauseum with BRICS. There's so many things bubbling under the surface. It just goes to show really how little most people are paying attention. And it drives me crazy. And, well, gold and silver haven't done a whole lot lately, blah, blah, blah. There are so many things that I could point to. People don't want to listen. Like, how is it that we're seeing record amounts of metal disappear? More gold accumulated by the central banks in the last 18 months than ever in history. Why? Why is COMEX now down to 29 million ounces in the registered category? And how about the fact that the commercial banks right now have 9,000 contracts short, roughly, about 45 million ounces, yet there's only 29 million ounces in bars that if everyone who took the other side of that short stood for delivery, we got a real big problem. 15 million ounces that isn't available for delivery. Where does it come from? Who's going to sell it? Are we that close to it blowing up? Is this why people have been pulling all their metal off the exchange? Is this why the commercial banks, according to Ted Butler, are not shorting the rising price? Also, they're trying to skillfully engineer their way out of this.
According to Andy Schectman, everything that is happening points to a massive storm on the horizon. Unfortunately, those orchestrating the whole fiasco are protecting themselves by loading up on record numbers of precious metals, while investors are fixating on price. Quoting one of the world's greatest investors, "Be fearful when others are greedy and greedy when others are fearful." Precious metal prices are clearly being manipulated by the same people that are loading up on these metals. The real question is, for how long can they continue the manipulation, and for how much longer will they need to? It is safe to assume that central banks are not just loading up on gold, silver, and other precious metals. There is an endgame in sight, and it might already be too late when that endgame is exposed. Let's get back to the interview as Schectman further discusses the need for adequate preparation for the coming storm.
And there's one very, very large managed money trader right now who really has the largest short position out of all of the managed money, or out of all of the short positions that he surmises may be BlackRock. But I don't know if that makes sense either, because they just took a huge position in PSLV. So there's so many things that should make people stop for a second and say, well, just because there's a moment of calm before the storm, well, let's just forget about it. And I think that's a big mistake here. Complacency is going to hurt. You talk about being prepared. Then again, I have said all along that whatever happens is going to happen. You could argue the old adage, gradually, little by little, then all at once. And that we always joke about that. Hemingway went broke that way. But many things in economics work that way too. Many things in this industry work that way. And if you haven't noticed, little by little by little by little by little by little, all the things that we've talked about for so long happening, then you sure as hell are only going to be blindsided when all at once happens. And that is the part that I think is maddening to me more than anything else, is people just think it all is okay because the last few episodes have blown over. So I guess we'll see. But if I had to guess, the old adage, the calm before the storm, will have great significance as we head closer and closer to a debt ceiling, which, by the way, if you look at the credit default swaps, I've been saying this for a few weeks now, they're going through the roof. The banks buy the credit default swaps because they are worried about a default on many things, mortgage-backed securities, on deals they have with other banks, And now, in this case, on the Treasury market, it hasn't been this high since right before the 2008 financial crisis. So, in other words, the insurance premium on backing a default by the Treasury hasn't been this high since '08. The sophisticated investors are telling you we're not out of the woods, even beginning to come out of the woods. And when Janet Yellen said if we close, the government doesn't find a way to keep the lights on, you'll see lots of banks, dozens, I think she said, fail. So is this the calm before the storm? In many respects, I believe it is. The backing, all of these things are centered around the continued destruction of the U.S. dollar through inflation. And there is no way out of this. If there just isn't, either you default or you inflate, because we're not going to produce our way out of this. We're not going to increase the production and the manufacturing in this country and have that engine of growth that will allow us to get out of this mess. Quite frankly, we've offshored all of our manufacturing and production. So you have two choices: you inflate or you default. And I find it very interesting that the people that are advising the president, their main thesis is get rid of the world reserve currency and blow up the banks and have a modern monetary theorist running the show. Now, could that just be coincidence? Sure, I guess it could. But then take a step back and look at all the things that we've done, like weaponizing the dollar, like telling Saudi Arabia we're going green. And that is the linchpin of this of the world reserve status, of the petrodollar. All of the moves that we are making are counterintuitive to a country that would cling to the great privilege it is to be the world reserve currency. Instead, we're like a spoiled kid who squandered away his great-grandfather's fortune, who started a company, and we're spending and spending and spending, and now asking to borrow some more. A country that has to borrow money to pay back money it's already borrowed, or to pay back interest on money that they've borrowed, it's just crazy. And here we are at the 12th hour of a debt default, and our president doesn't want to say what you want about both sides, right? But on one end, you have a president that is just will not agree to spending cuts and less taxation. So here again, they spend away our money. They give away hundreds of billions of dollars to the Ukraine that we can't afford. We have $50-60 billion left before we're out of money by June 1st. And then they expect us to pay more in taxes and go deeper into debt to borrow more money to spend on things that we can't afford. It's just crazy.
Massive unfunded debts, a potential default that could, in a matter of hours, cause stock prices to tumble by 30 or 40%, inflation that now seems to be baked in, and several other internal and external threats to the dominance and economy buoyancy of the United States. Yet American investors and policymakers continue to swear by the unequaled strength of the economy. What are your thoughts on Andy Schectman's interview? Do you believe there's a storm ahead for the U.S. and possibly the global economy? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on the notifications bell for more videos. Thanks for watching.